Ladies and gentlemen, things are about to get very, very bad very, very soon. I know what you're thinking. Michael, where have you been? Lately, they've been feeling like there's an imbalance in the force. The bulls have had a bit too much hopium. There's been some optimism to the start of the year that maybe all the problems from 2023 are about to just suddenly go away because the calendar has switched from 2022 to 2023. Well, ladies and gentlemen, I've taken a step back. I've gone away and done some deep thinking, some deep research about what I think is going to happen, because sometimes you can get caught up in the day-to-day, what's happening in the markets. But me, I want to know what's going to happen in the long term, to invest my money for my family, and also you want to know if you're investing for your future. What you may not really care what's going to happen tomorrow. It doesn't really matter. You want to know what's going to happen over the next 6 months, year, 5 years. Well, everyone, why I've been away, things have gotten significantly worse. And I've got some new data, some new news, and some facts to show you that all these rate hikes that we've been having from the central banks, we haven't even felt the major pain from it yet, but we are starting to get some early signs. There is mass layoffs being announced. A lot of the markets were having optimism that the Federal Reserve will stop lifting interest rates, but they've come out and said, no, we're going to keep on hiking. We've seen lots of big banks, they're having big issues. Their profits is falling, like with Goldman Sachs, and much more, which I'm going to get into today's episode. And people, this is going to be a good one. This is going to be an action-packed one to bring you up to speed about what's been happening in the markets over the past month and what is going to happen in the coming days, weeks, and months ahead. So, ladies and gentlemen, let's not waste any time. Let's get straight into the news, the facts, and the data. Well, everyone. Like I tried to warn about, 2022 will be one of the worst years since 2008. And that's right, the S&P 500, it corrected 20%. That is the definition of a bear market. And this was the worst year for the stock market since 2008. But people, unfortunately, what I think is that was just the preview for the main event that will be happening this year in 2023. And I think in the first half of the 2023, not the second half. And again, we've already got some new news and data and facts that are showing it is already happening now. Now, before I get into this, I know a lot of people are feeling a lot of optimism. They're hoping that 2023 will be the best year of their life. And I genuinely hope it is the best year. And I think you can make it the best year of life. No matter what happens in the markets, no matter what the government's doing, you can take control of your life. And why I'm saying things are going to be bad for the markets, it doesn't mean I'm trying to say it's going to be your worst year. You can actually use this information to benefit you no matter what's going to happen. And I'll also go over at the end of the video what I'm going to be doing to position myself against this market crash. Because look at this, everyone. All the bulls were saying the Federal Reserve is going to pivot. And you know what's funny? In 2022, they were saying, don't fight the Fed. Well, that's all the markets have been doing in 2022. They've been fighting the Fed, and they're still trying to do it now. But the Federal Reserve has come out and said that they see high rates ahead, even with progress on inflation. So I'm sure what you're seeing is inflation has come in at 0%, 0.1%, and even minus 0.1% the last monthly reading in January. But what happens with inflation is, if, for example, if prices go up 10% one month, and then the next month they don't go up at all, they just stay flat, well, then the CPI will say inflation for the month is 0%. Well, if prices are up 10% last month and they didn't go up anymore, really you have 10% inflation. It doesn't matter if this month they're saying it's 0%. When you look at annualized it's still 6.5%, which, yes, it isn't as bad as 9.1% what it was at the peak. And again, this is the CPI numbers. We all know the real number's much higher than that. Still, it is 3 times the Federal Reserve's mandate. So they've come out and said, and they've been consistent. You know, you've got some YouTubers saying the Fed pivot here, the Fed pivot there. You know, every day they're saying the Federal Reserve's pivoting. The Fed's been consistent. They're going to want to see unemployment tick up, and they're going to want to see inflation come down substantially to their 2% goal before they start flipping and lowering interest rates. Now, I'll get into a moment that inflation will plummet when the economy actually enters into not just a recession, but a depression. But then the market's going to go from risk of inflation being the risk. That's what the market's been really scared of the past year, because then that means high interest rates. Well, I think inflation will eventually come down, and then it may spike again like what it did in the 80s, and Michael Burry went over this, and I'll go over his comments in a moment. But then the next risk for the market is going to be, yes, inflation's falling down, but it's falling down because the economy is going into the toilet. And again, this is not just speculation, everyone. Look at these new announcements that's coming out from the biggest companies in the US and in the world right now. So look at this, everyone. Microsoft announced they're going to be laying off, and this is just the first round, 10,000 employees. And this has come after companies like Amazon has announced they're going to be doing huge layoffs, and they've announced more layoffs, which I'll go over in a moment. Because I did a video in December last month about Amazon announcing 10,000 layoffs, while they've now just nearly doubled it to 18,000 jobs are going to be gone in the initial first phase, but there's going to be even more cuts coming. So Andy Jassy, Amazon CEO, said an employee leaked the plans, prompting him to make the public announcement. And so this wasn't actually meant to go out to the media now. Maybe they're going to announce it later. So I wonder how many more companies are planning layoffs, but they just haven't announced it. And we may get employees starting to leak this information very, very soon. And again, people, this is just the tip of the iceberg, just the first stage. We're starting to see how these interest rate hikes are now starting to affect the economy. And remember, interest rates don't just go up and the economy crashes the next month. They have a lag of about 6 to 12 months, and that's 6 to 12 months when interest rates have hit their peak. We haven't even hit peak interest rate hikes yet, and they've been lifting them so fast, we haven't felt the full pain, but it is going to be coming. And look at this, the banks are taking a huge hit as well. Goldman Sachs is cutting up to 3,200 employees this week as Wall Street girds for a tough year. So the banks are putting billions and billions aside for loans going bad. They're announcing huge layoffs. These banks know what's about to be coming in the economy, and people, it is not going to be good. These major companies are preparing, the banks are preparing, and you need to get your house in order right now before it's too late. So what we're seeing right now is volatility in the markets. The unemployment rate hasn't gone up yet, but we're starting to see lots of companies announce layoffs. But we need more proof that the economy is slowing if we think a recession is going to hit in 2023 or even a depression. And people, we did just get this data as well. Look at this, everyone. Weak US retail sales and factory data heighten recession concerns. Purchases decreased. That's right, they went down 1.1 in December, missing median estimates. So again, people, this is absolutely crazy. Normally December, it's a holiday season, people are spending lots of money, but no, they actually went down 1.1%. And that's because people's personal savings rate is going down. Consumer debt is at all-time highs, which again, I'll go over in a moment. So this is a recipe for disaster, and the consumer has been tapped out. They're not getting any free money from the stimulus checks anymore. Their stocks aren't going up. They can't spend money from the stock gains they've had. Cryptos aren't going up. They can't use their house as an ATM anymore because they can't refinance, because if they refinance, they're going to have to go on a much higher interest rate, and we're all going to feel the consequences of this very, very soon. So stocks have already crashed about 20% in 2022, but how bad could it get in 2023, and how much further does it have to go? Well, Morgan Stanley has recently put out some of their predictions, and they actually got it right in 2023. They were calling, Morgan Stanley a perma bear last year, but they were actually the most accurate out of all the major banks. So look at this, everyone. Morgan Stanley's Mike Wilson warns US stocks could slump another 22% if recession arrives in 2023. And people, we did already have a technical recession in 2022, but the government didn't want to admit that. But I think there isn't going to be any way to hide it whatsoever. I think by all indicators, we are going to enter into a deep recession in 2023, and the markets haven't priced this in. I'll go over again in a moment how the market is still overvalued, even though it's come down 20%. We've seen stocks crash massively like Tesla. Tesla's down 60, 70%. People were thinking, that would never happen, but it has happened. And people think this recession is never going to happen, but it's not a matter of if it will happen, but when. The Bear Lord himself, Michael Burry, has come out and given his thoughts of what's going to happen to the economy and consequently what will happen to the markets in 2023 as well. And people, I think he's absolutely spot on here. So look at this, everyone. Big short investor Michael Burry predicts a US recession in 2023 and another inflation spike. Look at this tweet here. Inflation peaked, but it's not the last peak of this cycle. We are likely to see CPI lower, possibly negative in 2H 2023, and the US in recession by any definition. the Federal Reserve will cut and government will stimulate and we'll have another inflation spike. It's not hard, he says. So I agree here, and this is what I've been warning about. When the real recession hits, inflation will fall down. But the government will do what they always do. Instead of innovate, try to restructure, they'll just throw more money at it. They'll throw more fuel on the fire. Inflation will spike again. And this is what happened in the 70s and 80s. They lifted interest rates. Inflation went down a little bit. Then they dropped interest rates. Then they had to lift them higher again. This is why Paul Volcker had to come in and lift interest rates up to 18%. Because every time they lifted interest rates and then CPI would fall a little bit, they cut rates. And then that would just cause inflation to spike again. And he's saying this is the risk we're going to be facing here. And I think he's absolutely spot on. Because I don't know about you, but if you've been shopping for eggs lately, egg prices have actually skyrocketed. They're up 49% in the past year. So it may actually be a good time to start investing in chickens, people, not the S&P 500. Now, a big reason why inflation has gone down is because oil prices have gone down. And that has a flow-on effect across all things, across all goods, because it takes transportation to transport those goods and it takes fuel to do that transportation. So if we see energy costs skyrocket again for whatever black swan event that could happen in 2023, we're going to see another inflationary spike as well. Now, quickly for all my Australian viewers that think the Australian housing market will never crash, well, we've got some new data for you as well. And this is also going to be happening in the US as we start to see the effects from high interest rates on the housing market. And again, this is something called the wealth effect. When house prices fall, people feel less wealthy. They're going to cut their spending. And again, they're not going to be able to refinance and take equity out of their homes, or they're going to have to pay high interest rates. And their debt payments are going to go up. And if their mortgage payments are going up, they're not going to have as much money to spend on the goods. One person's spending is another person's income. And this has a flow-on effect. Look at this, everyone. I did a video in 2022 saying the Australian housing market crash will rival the US 2000 subprime mortgage crisis. And why this is beginning, national home prices are down 5.3% over 2022. You have further declines are expected in 2023 because, again, interest rates haven't peaked. And there's some areas like Sydney where they're already down 12%. So I don't think we're anywhere close to a bottom in the Australian housing market or the US housing market. But again, let's go back to the US economy, the US market, some more data points to show there is going to be more pain for the US stock market and the economy. Well, this, everyone, another huge indicator that's predicted every single major recession, and this is the worst it's been in 40 years. The difference between the 10-year US Treasury yield, called the yield curve inversion, is now minus 0.7%. Again, the worst it's been in decades. This is signaling there's going to be a big recession coming. Now, another thing with economics, people try to make it so complicated, but it's not complicated at all, people. Do people have money? And do people have the opportunity to take on more debt to fuel their spending if they have no more money? Well, people's credit cards are now maxed out and their savings have been dried up. Look at this data. So this is the US personal savings rate. And we can see here it is now tanked to a new low of 2.4%. So what are people doing? They're taking on more and more debt. Debt has just hit a new high for total consumer debt in the US of 4.7 trillion. And like I said, there's no more stimulus checks coming to save the day. People aren't going to be able to take on more and more debt because interest rates are so high. So the only way to fix this issue is to let the markets crash, let things come back to fundamental fair value, and rebuild from a more sustainable base. Because this is completely 100% unsustainable, the path we are on, by taking on more and more debt, by using our savings, by making prices go up through the roof so people can't even afford them. We need a reset in the markets, and it is going to be happening this year. It is just simple nature. Everything in the markets, there's cycles, there's peaks, there's troughs, there's boom cycles, bear cycles, and I think we're going to enter into a prolonged bear market because we've had a prolonged boom over the past 30 years. And look at this, everyone. This is the S&P price to earnings ratio, and this is showing even though we've had a 20% decline in the markets, they're still overvalued. It's got a price to earnings ratio here of 20.2, and the medium is 14.9, and the mean is 15.9. So we still have at least another 20% to go for the stock market to fall back down to fair value, especially with high interest rates. Now people can actually get savings or earn interest on their savings now. They can get interest with bonds. So the stock market has a lot more competition. And now let's get into what I think will be a way to protect yourself against this downturn coming. Because what have I been harping on about the past year, everyone? Been saying the stock market's going to crash. I've been saying cryptocurrency market's going to crash, the bond market's going to crash, and they have. And I even said gold and silver will initially sell off, but once we see the risk of recession become real, once we see the stagflationary risks, we're going to see gold and silver skyrocket. And that's what it's been doing. Gold and silver has been outperforming every single asset class over the past year. Even though Bitcoin has had a rally here and there, it's still down significantly from its highs. So let's have a look to see what gold and silver has done recently. So look at this, everyone. Gold has risen to a near 6-month high, and today it has hit $1,930. So that's right. I remember it was around $1,600 when I was saying there's some opportunities here. So we finally starting to see gold have some significant moves, but also silver. Silver hit $24 an ounce today. I was telling people, around $19 per ounce, it could be a good buying opportunity to get in. And again, this is a way to hedge, to protect yourself against, economic Armageddon. So everyone, I know what you're thinking, well, okay, what does all this economic jargon mean for you in simple terms? Well, what this means, everyone, I may sound like a broken record, but you need to remember it because people get distracted, okay? We have not seen peak pain in the markets yet. The Federal Reserve is still going to lift interest rates. We haven't even got all the data to see how bad these interest rate hikes are going to have in the economy. We are getting the early signs that it's not going to be good, but people, it's going to get much, much worse. Again, I've been telling you I'm waiting for at least a 35 to 40% decline in the S&P 500 from its peak to start buying in. I've been buying gold and silver to hedge against this crisis so my money doesn't get devalued. I've been storing cash on the side as well to buy the dip. At least I'm getting some interest on that cash now. And I think later in the end, probably Q3, Q4 of 2023, there's going to be some real buying opportunities. And that may be when the Federal Reserve does actually pivot and we're going to see some short-term rallies here. But of course, I'll keep you updated. Now, I know I've had a break off YouTube for a month. Again, I'd like to take these steps back every now and then to try to reevaluate, go into some deep research, some deep studying, what I think is going to happen in the markets, not get caught up in the day-to-day. But I am back now. I'm going to bring you more frequent, probably 3 to 6 videos a week, maybe even if there's some crazy news, maybe even 2 videos a day. So I'm going to be back at it full schedule. It's good to be back. Good to see you again. What do you think is going to happen in the markets this year in 2023? Let me know down below. Thanks for watching, and I'll see you all in the next video.